Hello, International Finance students. We are in week 5. We're quickly approaching the end of the course, but we do have a busy week this week. Just a reminder to our today, your paper is due by midnight tonight, so all the week 4 materials are due tonight. For week 5, we look at the syllabus. We have an exam. I'll put that out there today, so you have the whole week to do that. We do have a forum discussion, which I actually have you go to a website and look at the volatility of a currency. So just follow the directions in the forum discussion and kind of answer the questions. So I want you to pick a currency and see what happened to the change in the value, and then kind of express your opinions, whether perhaps you're willing to go unhedged with a currency or you prefer to hedge a currency. Are you a risk taker or risk avoider? It's a little bit kind of a philosophy of what a business manager would do. We also have some homework problems and the readings of chapters 9 through 11. And again, the reading kind of gets technical as we move along here. So again, take your time, space it out through the week, and kind of a little bit of overview for these chapters. In chapter 9, we looked at foreign exchange rate determination and forecasting. They give some principles of why foreign exchange may change. Some of those we've addressed already, like the parity or balance of payments. But a lot of this chapter looks at the asset approach. It could be different government intervention, it could be monetary policy. And as a manager in M&E, it's trying to anticipate what's going on. There's all types of risks. There can be political risks that go on. So it's important to kind of understand the past and be cautious about just making assumptions that, say, exchange rate, if it's fixed rate, will always stay the same and nothing to worry about. So they gave like 3 examples, the Asian crisis, the Russian crisis, and another, to kind of just help reinforce some of the past lessons. We look at anything with forecasting. Let's say bottom line, forecasting is hard. And they go back to the idea of efficient market hypothesis, that if all information is available in the market, any changes in foreign exchange should quickly reflect that. But there are also those that believe in technical analysis, that patterns exist in markets, and it's kind of a bit of a debate. Probably academia would say we focus more on the fundamentals, but technical analysis say that trends exist. Well, if you truly believe in efficient market hypothesis, you would say that no past information can predict the future. That way trends would really kind of be worthless. But if there's some gray area in there, maybe there is some trends that exist. Okay. Chapter 10 looked at that transaction and translation exposure. Most of the time it's been on the transaction exposure, but they start off kind of discussing 3 areas that kind of even cover into chapter 11. But the transaction, a change in cash flows, the translation, how does this impact financial statements? And then finally, the operating. So how does this impact the present value of the firm? So kind of briefly talk about that transaction exposure, how we might want to maybe perhaps hedge against that. And they mentioned some different types of hedges. One could be just simply I go out and I do a money market hedge, or I can do a forward hedge, or I can do an option hedge that may allow some movement, if it goes in my favor, to actually add for profit. Again, remembering all of these hedgings cost money. So some managers may decide not to hedge at all and just kind of take the risk. I remember I was in the corporate world. If it was below $250,000, we just kind of let it ride. But if it was about greater than that, we try to lock in the price for some payment that we might have in 30 days or 90 days. Kind of also the last part of this, they talk about the translation of this chapter. So they give a good example on page 285 about the current method and temporal method. Current method a little bit more strict. Temporal method can adjust certain accounts. And the idea is to try to give a clearer picture of the better picture of the balance sheets and the financial statements, to kind of what's happening here, so investor knows better. Last wrap up this week with the operating exposure. And with the operating exposure, bottom line, this is that if I'm trying to forecast out the cash flows for a firm for the next 5 years and I'm an investor, how does any changes in foreign currency impact the bottom line value of this firm? So they give us a nice example on page 306, and I kind of read through that, kind of make sure you're comfortable with understanding where these cash flows, how they're changing. They do these different base case scenarios. It's common, almost like a simulation analysis, or really a financial manager wants to know the what ifs if something changes. So That's kind of the brief mini lecture for this week. I do have a written mini lecture out there. But do send me an email if you have questions. But have a great week. We'll talk to you soon.